start the recording. You need to accept that on your screen. And okay, good. And then I can go ahead and put chapter 2 up. And my machine and tablet mode. Hoping that nothing goes wrong in that process. Okay. All right, good. And full screen. Okay, good. So everything seems to be working. Okay. So what we're going to start to look at here in chapter 2 is financial management. So remember, when we're looking at the BEC exam, we're getting outside of areas that are traditional accounting areas, and this class is looking at some areas that you probably covered in your finance class at some point in time. So we're going to talk about capital structure. We're going to be talking about the weighted average cost of capital and some different ways to optimize that. That's about 5 points when you take those two areas, all one really big area, but they break it into two to supposedly make it sort of better bite-sized pieces. We'll start talking about working capital, and when we get into working capital, that's about 5 points. And you'll also see in there that we do have some areas that you probably covered in financial accounting, intermediate accounting a little bit. So some of that will be pretty familiar to us from some of our accounting classes. And then when they get into this area down here, which I'm thinking we will actually get to next time, and they start talking about financial valuation, financial decision models, we're going to be talking about things like net present value analysis, and et cetera, things that I know you had exposure to in managerial accounting, and I'm going to go ahead and put a 10-point label on that whole area that we'll cover next time. Don't forget, guys, sometimes students think, well, he only says 5 points. That means I don't have to study it. It does not mean that. I'm just trying to give you a sense as to how many questions you might see on the exam related to this topics. You can think that you're going to see a task-based simulation if I put a 10-point label on some of these. You can't ignore anything that we go through and study, and I ask you to make flashcards on, and you see multiple choice questions on. You must study those areas to be successful on your BEC exam, of course. And let me reiterate, make sure, as I've said several times now, please make sure that you are registering for the exam or making plans as to when you will register for the exam if you don't think you're going to be eligible yet, but make sure you're registering, scheduling your exams. We're still shooting for May 1st as the date that we would like to be able to take our BEC exam. And the state is still moving pretty quickly through processing paperwork. So if you're filing under option C because you think you will be able to prove that you have met the requirements in 6 months from now, you should probably already have received your approval. And if not your approval, even your notice to not only your approval, your authorization to test, but your notice to schedule. If you're thinking, hey, I'm going to be getting the documentation to prove that I met the requirements, within 180 days of sitting for the exam, and I can get that in 240, again, you should be registering and planning to sit for that exam. Okay.
Professor, can I ask a question?
Yeah.
So how do they send the approval back to us? Through email or through mail?
Email.
Okay.
You should get an email to whatever email you gave them when you register, when you set up your account and stuff. I'm a little surprised that you're asking me that because it's been about 2 weeks, right, that we've started this class. So if it's not there yet, it should be. I'd give them no more than we'll say by Friday. If you're not hearing from them, I think you're entitled to start making some phone calls and finding out what the heck's going on, because you should have gotten something already or pretty quick.
No, I didn't send out the document until last Thursday.
Okay.
Okay, thanks.
So next week you should be getting something in the email is where they send it. Check your spam filter if you're not seeing something. Okay, good. All right, so let's go ahead then, if there's no other questions, and jump into our material for tonight. And these first few pages, guys, I don't find particularly useful. Telling us about debt financing, different types of bonds, what a junk bond is, leasing. I don't think we need to spend a lot of time equity financing, the different types of different types of stock, common vote versus preferred stock. I don't see that we get a lot of mileage out of that. So I just want to jump us to our first area here where they actually start doing something other than giving us very basic definitions of things that we already know, and talking about this notion of the weighted average cost of capital. Okay, and you can see that the weighted average cost of capital serves as a major link between the long-term investment decisions associated with the corporation's capital structure and the wealth of the corporate owners. The weighted average cost of capital is used internally as a hurdle rate for capital investment decisions. So when we get into the second half of this chapter and we start talking about those decision models like the internal rate of return, net present value method, the hurdle rate that we use to make those investment decisions often is the weighted average cost of capital. We're going to be learning about that here tonight. So what the weighted average cost of capital strives to do is to get the mixture of debt and equity that produces the lowest weighted average capital and maximizes the wealth of the firm. So why don't you go ahead and flashcard that? But basically, we're going to see that, an entity is trying to make a decision about, they're going to acquire some sort of capital asset, and they're trying to see, well, we want to borrow some money and we want to issue some stock, and we want to come up with an optimally model of mixture of debt and equity that will make the weighted average cost of capital as low as possible, minimize that, and thus maximize the wealth of the firm. So that's where we're going on to the next page. And you're going to see that we're going to give you the formula for calculating the weighted average cost of capital. Now, fair warning here for this particular lecture, be prepared to get a little bit of writer's cramp when you're making flashcards. A lot of formula in here, and thus a lot of flashcards. Now I say get writer's cramp. Don't forget that you do have pre-made flashcards that you acquired as part of your materials with Becker. And so if there's already, and I bet you $1 there is already a flashcard for many of these formula, just pull it in there. You don't have to sit there and write it out longhand if you already have a card pre-made from Becker with these formula. Then you just pull it in. And I think that's really the case to a large extent with a lot of these. Okay, but let's go ahead and just take a look. The weighted average cost of capital is determined by weighting the cost of each specific type of capital by the proportion to the firm's total capital structure. And you can see the formula there, but let's just go ahead down to this legend here and see what these different symbols mean, different letters mean. And the value is going to be the sum market values of the individual components of the firm's capital structure. Okay, and so we're going to add together the portion that is going to be common stock. We are labeling that E, that's equity. The preferred stock, we're labeling that P, and the debt, we're labeling that D, and then we will add E plus P plus D together, and that will equal V. Then we're going to deal with the required rate of return on each one of these elements. That's the R, RE for equity, RP for preferred stock, RD for debt. And then we have the corporate tax rate. Now, corporate tax rate only applies to the D, only applies to debt, only applies to debt. And I got to get me a new pen because this one is shot. So I apologize for the bad writing wasn't good to begin with, and now it's bad because my stylus is messed up. But the key thing is the tax rate only applies to the debt because debt is tax deductible, and we take 1 minus the tax rate, because what we're saying is, look, you're going to shield a certain amount of income from tax because you're going to have this deduction for the interest on the debt. And so we go ahead and take 1 minus the tax rate for that. So flashcard, or make sure you have taken a good look at the flashcard and memorized it, the pre-made flashcard. Okay, so that's really maybe what that FC means more than make the flashcard. It means memorize the flashcard, right? And then let's just go ahead and take a look at this example here. So we have the facts here. Assume the cost of common stock equity for XYZ is 8.4%. The cost of preferred stock is 6.8%. And the weighted average interest rate on the company's debt is 6.0%. And we're going to look in the upcoming pages as to how to calculate those various numbers that were given there for the E and the P and the D. Right now, we're just showing if you were given those in a question, then this is how you would apply them to calculate the weighted average cost of capital. So now they tell us that assume the market value percentage, okay? Assume the market value percentage of each component of the capital structure are 55% common stock, that's going to be our E, 20% preferred stock, that's our P, obviously, and 25% debt. And then they give us the corporate tax rate of 30% because we're going to have to take 1 minus that 30 or 70%, and we only apply that, as I said, to the debt portion. So you take a look, and you could see that they have gone ahead and figured out 4.2 for the interest rate on the debt, 66% times the 60%. Times the 70%, 1 minus 30 is 70%, gives us 42% for the tax. And then we just apply those costs to the proportion that is made up of the equity, the preferred stock, and the debt, and our weighted average cost of capital, 7.03. And then, as I have stated, then we will go ahead and use that potentially as a hurdle rate for making investment decisions, maybe if we're using something like the internal rate of return. Question? Okay, good. Now let's go ahead and start to look at those individual components. Okay, and we're going to start in a minute here with our cost of cost of debt. But before we do that, let's just take a look. And they're telling us that when you deal with long-term items, okay, that's really what's happening with our common stock, our preferred stock, and our debt. Short-term elements, and the key thing I can tell you there, if they tell you something is short-term, then look for an interest rate. Okay, now I'm telling you that, but the reality is that short-term items, okay, it's really generally a note payable, okay? Other types of short-term items like payables and accruals don't carry an interest rate with them and therefore would be ignored in calculating the weighted average cost of capital. For the most part, they're going to stick with these items up here in questions. If they talk about some sort of short-term note, a 90-day note or something, give you an interest rate on that, then treat it the same way you would an interest rate on longer-term debt. Okay, good. Come over and let's take a look at the weighted average cost of debt. Okay, again, we're going to deal with how to calculate that weighted average cost, which was given to us in that example. Now we're going to look at how to calculate them for, again, starting with the debt, and then we'll get into the preferred stock. And then when we look at equity, we're going to see that there are actually 3 different methods that we can actually use, and we may average those 3 different methods to come up with the cost of our debt. So to calculate the weighted average interest rate is to take the effective annual interest rate of the company and divide that by the debt that was outstanding for the year. So just go ahead and flashcard that. That was given to us in the previous example, and all they're telling us here is how to calculate that. And again, as we had seen, we have to deal with the after-tax cost of that debt. And we already saw that the after-tax cost is the pre-tax cost of the debt. In that little example, it was what, 7%. And then we multiplied that by 1 minus, it was 6%. And then we multiplied that by 1 minus the tax rate. Tax rate was 30%. We multiplied it, therefore, by 70%, and that's how we came up with that 4.2. So we've already seen how to do that. The only difference here is we now had to learn how to calculate that weighted average cost of debt. Okay, I'm not going to go back through another question on that now, because we have seen how to apply the tax after tax rate. That's really a repeat of something we've already looked at an example for. Okay. Okay, good. Let's look at cost of the preferred dividends now, the P, and you can flashcard that, and that's going to be the preferred stock dividends divided by the net stock proceeds. Now, preferred stock dividends, you can see here, and I'm not trying to insult anyone's intelligence. I know you've been through intermediate accounting and you already studied this. But preferred stock dividends can be stated as a dollar amount or as a percentage. For example, 5% preferred stock dividend pays an annual dividend of 5% on the par value if dividends are declared by the corporation. As you well know, corporations don't have to declare dividends, but you'd have to look at some information in the question that says that they had preferred it, that they had declared it, and they often declare it as a percent. They may just give you the dollar amount, but they may call it out as a percent, and that percent is applied to the par value. So go ahead and flashcard that. I mean, I think you know that, but just to make sure that you're comfortable with that, go ahead and flashcard that. You also can make a flashcard to remind yourself that you need to consider the net proceeds off of the preferred stock. So if there's some sort of issuance cost associated with that stock, then you're going to have to share those with an underwriter or a broker or somebody like that when you're issuing that preferred stock. And so that would have to be subtracted off of the total par to get the net proceeds. And I think when you look at this example, you'll see that all that's pretty easy to deal with here. They tell us that it's a 10% stock, 10% preferred stock. The par value is $100. And then they tell us that there is a flotation cost. You're probably paying some sort of underwriter or something, $5 per share. So the net proceeds, let's just deal with that denominator first, is 95. The numerator here is the par value of the stock times the 10%. So we have a dividend of 10. And so you go ahead and you do the math on that, and you get the cost of the preferred stock, 10.53. Now, I think that, you know, most questions you see will ask you of elements of this weighted average cost of capital. I haven't seen too many questions where they get off into making you calculate all the elements and then, you know, put those together to come up with the weighted average cost of capital. So you probably will see questions that will isolate the elements to see if you know how to handle each one of these. There's a chance that you could have a task-based simulation where they ask you to put all of that together. So again, it's important that you're making these flashcards, you're studying these examples, you're getting very nimble at putting together the calculations here, because we don't want you to get into a time crunch when it comes to some of this stuff that can get, can get a little bit scary if you're having to sit there and crunch up a bunch of numbers. Okay, so we've seen the debt, we've seen the preferred stock. Let's deal with the E, the cost of capital, the cost of equity, I should say. And for the cost of equity, we're really going to be looking at, well, look, what is the cost of using the retained earnings of the company for reinvestment in some sort of, capital investment of some sort? Because the alternative is, hey, if you're not going to reinvest the retained earnings, pay me a dividend. There is absolutely no benefit to the shareholders of a company just hanging on to the retained earnings, I guess, in the form of cash or I guess pretty much in the form of cash or some other asset that's not giving us a return, but pretty much cash. Hey, just give me the dividend and I'll take the dividend and I'll invest in another company who's investing their retained earnings and having some sort of return off of that, right? Okay, so there are 3 common methods of computing the cost of retained earnings: the capital asset pricing model, which is my personal favorite because I think it's kind of fun, discounted cash flow method, bond yield premium, which is abbreviated BYRP, bond yield plus premium. Okay, as I've said, not that the one that's my favorite is of any concern to you, I like this CAPM. I don't know why. I just kind of like messing around with it a little bit. It's kind of fun to see how it works. Okay, so let's just take a look at this, and we have some assumptions here. The cost of retained earnings is equal to the risk-free rate of return plus a premium. Okay, risk-free rate of return, although they don't always articulate it that way in questions, but just be aware that the risk-free rate of return is the rate of return on federal securities. Essentially federal what? Federal debt. Okay, that's considered the risk-free rate of return, and that's why you kind of heard me. I think I went off the other day in class a little bit about this notion when people sit there and say, well, it's okay if the government defaults on its debt. No, it's not. It is not okay if the government defaults on its debt, because what? Federal government defaults on its debt. How does any other institution make a decision as to what would be an appropriate cost of their capital if there's not a risk-free rate of return to start with? Then we go ahead and adjust that for a firm-specific risk premium, okay? And so that is called the market risk premium is equal to the systematic non-diversifiable risk associated with the overall stock market. And then we go ahead and we adjust that for a beta coefficient, okay, which measures the volatility of the stock relative to the overall market. Okay, and let's go ahead and flashcard this part. A beta, this part I'm highlighting in yellow, a beta equal to 1 means that the stock is as volatile as the market. A beta greater than 1 means that the stock is more volatile than the market, and a beta less than 1, okay, they're a little lazy here, means that the stock is less volatile than the market. So they kind of put that all in one sentence. Could have had a separate sentence that more beta more volatile, beta less volatile. Okay, and then you can see that the premium is the stock beta coefficient multiplied by the market risk premium, and then the market risk premium is the market rate of return minus that risk free. Okay, so we have a residual risk above the risk free that's applicable to the entire market. That is considered the non-diversifiable risk, and then we multiply that times the beta coefficient, which now adjusts that risk specific to the firm that we're doing this work for. Okay, so you come over and you can see the cost of retained earnings. And notice right here, guys, is what I'm going to ask you to flashcard. Okay, you're basically probably going to be given those factors in a question. I mean, they're not going to make you calculate the risk-free rate of return. And then the risk premium, we already know, is the interaction between the beta and the market risk premium. And the market risk premium, maybe you need to make a flashcard for that, that the market risk premium is the market return minus the risk-free rate. Okay, but let's just go ahead and look at this example, and I think you'll see that it's kind of fun, kind of interesting, and pretty easy. So assume that the firm's beta is 1.25, the risk-free rate of return is 8.75, and the market rate of return is 4.25, and they want us to use the CAPM to calculate the cost of the retained earnings. Again, this is one of three methods that are available to calculate that E part of the weighted average cost of capital using this CAPM, the capital asset pricing model. So you take a look and they just pick up the elements. We have what? We have the 0.875 is the risk-free rate, and then we have the beta, and then we have that risk premium, which is the beta times the risk-free rate minus the market rate of return minus the risk-free rate. And so then we go ahead and do the math on that, and this company's CAPM is 15.63. Question? Okay, good. Let's look at our next method here, which is the discounted cash flow. Okay, and let's just come over, and we can see that there's some key assumptions here, but the one that I want to focus on here, that first one's not that enlightening, but let's take a look at the estimate expected rate of return will yield an estimated required rate of return, and then we're going to go ahead and adjust that for an expected growth rate. And you can see that they give us a formula for that as well. Again, you probably have the flashcard already made for you, but you need to memorize it. And notice that they are showing the amount of dividend that's going to be paid out in the expected at the end of 1 year. What is the dividend? I'm just starting with the first part of that. Okay, we divide that by the current market price of the outstanding common stock, and then we add a growth rate to that. So we're basically saying, hey, this is the cost of using the retained earnings. Instead of using it for dividends, now we're going to use our retained earnings to reinvest. This is the cost to our shareholders, and we're putting that in as a consideration of the equity financing portion of our weighted average cost of capital, because we're saying, well, hey, this is what's costing our shareholders, because I can't get this in the form of dividend now if we're reinvesting it to invest in a particular project, whatever. And so we're using that as part of our decision process and coming up with the weighted average cost of capital, which we'll see next time we'll use as a hurdle rate in making various investment decisions. Okay, so let's go ahead and let's take a look and assume that a firm has a constant growth, firm is a constant growth firm that just paid an annual common stock dividend of $2, has a dividend growth rate of 7.5%, and a current price for common stock of $25.25. So what happens? We go ahead and we take the dividend times the growth rate, and it's 1 plus the growth rate, because of course we want to keep the 2 and we want to see what that dividend would be growing to. And so the dividend is going to grow to this 2.15. We take the 2.15, we pick up that number from the question here, which was our P naught, okay, which was the 25.25, and then we go ahead and add to that the growth rate on the stock, which they told us on the dividend, which they told us is 0.075. And so we go ahead and we come up with this 16.01 is the cost of the E, again, the equity, our second method for calculating that using discounted cash flow. Okay. Okay, good. And then the third method is the bond yield plus risk premium. And let's just go ahead and take a look at that on the next page. And basically, the cost of retained earnings for this method is going to be the pre-tax cost of debt plus a market risk premium. You can flashcard that, but that one's probably the easiest one of all of them. So assume that a firm has estimated its market risk premium of 4.5 and has determined the yield to maturity on its own bonds of 11.34%. You simply add those two together to come up with the bond yield plus risk premium. Okay. Okay, good. Now, what they tell us here is, no one of these is king. Again, I like the CAPM, but no one of these, God doesn't come down and say, well, you really should use the CAPM all the time, So what you could do is use all three methods and then just go ahead and average that. Since there's three different methods, you would divide that by 3 to get the average of the three, and they just use the number from our problems here. So that's fine too. Okay, any question? All right, guys, let's go ahead and try out our new set of questions for tonight. And I'm going to go ahead and put the poll up. And I think I might give you a little more time tonight. I think it's going to be okay to maybe give you, 3 minutes per question, since we're starting to now get much more into some of these calculations. So go ahead and have fun with this one. Okay, guys, let's go ahead and take our best shot at this one. And I'm going to go ahead and end the poll. And some of you might have needed more time, because I noticed here as I said I was going to end the poll, then all the votes started coming in, and our correct percentage went down, because the correct answer here is A. And the folks that had chose the answer a little sooner got it correct, and then as some of the later answers came in, our percentage went down. And so we're kind of all over the place on this one, and that doesn't surprise me, because there is a trick element to this question that is a little annoying. Okay, and that, let's just go ahead and read through it. This DQZ Telecom is considering a project for the current year which will cost 50 million. DQZ plans to use the following, and they're going to use 15 million of debt and 35 million generated from retained earnings. Okay, so they're giving us the D and the E here. You know, there's no preferred stock, and they don't have to use preferred stock in a question. So if you take a look at this, we know that we have what, 15 coming from debt, and we have what, 35 coming from the equity. Now, the first thing I would do is go ahead and just set those up. 15 divided by 50, 35 divided by 50 is the way I'm going to portion out my equity and my debt using our WACC formula. Now, I need to get the after-tax interest rate to apply that to the debt. So they tell me that the interest rate on this is this 8%. Okay, but I have to do what? I have to multiply that by 1 minus the tax. Where's my 8% here? Actually, I don't use the 8% here. They tell me the equity is expecting 12%. And they tell me that the beta coefficient is estimated to be 0.6, subject to effective. Assume that the after-tax, here it is, cost of debt is 70%, and the cost of equity is 12%. So as I look at this, I have to, and I'm trying to remind myself here why I put times 0.07. That doesn't seem right. Why did I put 0.07 here, guys? Sorry. Now I'm drawing a blank here.
It's 30% times 7%, and then 70% times 12%, right?
Well, if it's 1 minus the tax rate that I have to use for this, so if the tax rate here is sitting at 70%.
Well, but you're already told that that's the after-tax cost of debt is 7%.
Oh, thank you.
Yeah.
Thank
You
you.
have all that unnecessary information that they give you to waste your time.
Right, thank you. Assume the after-tax cost of debt is 7%. I was trying to figure out why I wrote down 0.07, because I wanted to use the tax rate, and you're correct. So I have to use what? I have to use the 0.07. I apply that to the debt portion. Thank you. And then what's annoying about this question, and maybe why it started to take you some time, is they do give you the elements so that you would sit there and think that you should be using the CAPM, because they do give you elements to use the CAPM, but at the end, they tell you that the cost of equity is 12%, and we have several methods, or 3 methods, that we can use to calculate the cost of equity, so we don't have to use the CAPM on this. That was the thing that I think probably messed some of you up, where you were sitting there trying to, you know, put all those numbers in, like, I don't know who said it, but all that unnecessary information. So you sit there and you just use the 0.12 there that they gave us to apply to the equity portion. And when you do the math on that, now you get the 10.50. Okay. So you can see from my own stumble there that it is easy to get locked into a lot of that information there and start saying, well, where am I supposed to get this? When they basically waited to the very end of the question to give us the percentages we needed to apply to these various types of financing, the debt and the equity, to come up with the answer here. Okay. Okay, good. Let's go ahead and let's take a look at the next one. Okay, guys, I'm going to go ahead and wrap up the poll here. So make your best choice. And okay, good. Yeah, this is very good. That's 100%. So that's pretty good. I don't think I can ask for much more than that from you. I'm just trying to share the results with you, and it doesn't seem to want to let me do that. Let's try it again. There it goes. Okay, good. I wanted to put that one up because that's, I think, the first time we've had that where everyone got that one right. So let's go ahead though and just let's take a look at it. Okay. And get that out of my way here. Okay. Okay, good. So we have the cap in, and we know, and when I'm looking at a question like this, and I know I have to pick up that risk-free rate of return, something like this, I just pick that up. I know that I'm going to be adding a risk premium to that. So I know I got this 6%. I got the point, I'll put percent on, I'll put 0.06. I know I got that. Okay. then I have to put in that risk premium, and the risk premium is the beta coefficient, okay, which was the 1.25. And then we're going to have to figure out, well, what is the market premium? And it's what, the 14%, the 0.14 minus the 0.06. And then you go ahead and you do the math on that. And that's how you came up to the correct answer, which you all got good, was 16%. Okay. Okay, good. Just a quick administrative thing. I want to make sure I know who's here. Is Brenda here? Okay. How about Elton Cabralo? Okay. Trevon? Okay. Is Laura here? Laura Eagler. Okay. How about Ligden Lee? Okay. Is Nazane here?
I'm here.
Okay, you're the Zoom user. Okay,
Yes.
good. Okay. Thank you. Sheila?
I'm here.
Okay, great. Jason?
Here.
Okay. Jason Prasad, I'm sorry. No. How about Nidhi, N-I-D-I-H-I?
Yes, I'm here.
Okay. Thank you. I don't think Victorino is here. Yishan? Hatron? H-A-T-R-O-U-N-T-R-U-O-N-G? Okay. Okay, good. Yeah, we're losing some folks, and I don't know if they plan to drop the class or not, but a key element of this class, of course, is being in attendance and doing all this hard work that you're doing, right? Okay.
Professor, I didn't hear my name.
I only called folks that I didn't see their name on the screen.
Oh, okay.
Got you, Nicole. Yeah, I had, during the question, I had checked off who I saw on the screen, but I checked my work because I knew that it's kind of hard. It's not an alphabetical order. And so sometimes it gets a little difficult to catch everyone. That's why I went through and called out the names that I didn't check off. Okay, good. So let's go ahead and let's take a look now at our second module, in which we're going to come up with the optimal cost of the capital, okay? And really, this is a continuation in what we've already talked about. The ultimate cost of capital is the ratio of debt to equity that produces the lowest weighted average cost of capital. So now that we understand how to calculate the weighted average cost of capital, how will we determine the appropriate mix between the debt, the D, the C, the D, the P, and the E to optimize the wealth of the company? So let's go ahead and take a look at how loan covenants can affect capital structure. And I want you to flashcard something there at that bottom of that section, which is what that last sentence there, which is when a borrower has a significant amount of outstanding debt relative to equity, loan covenants will typically increase and become more stringent because there is more risk to the lender. So we don't want to ignore the use of debt because debt is tax deductible. And so that can lower the cost of that particular type of financing. But by the same token, if we get too mired in debt, then loan covenants start to kick in, which can raise those interest rates up. And loan covenants, is something that auditors will look at to make sure that those are properly disclosed, because those can be very important to creditors, investors to know the ability of the entity to maintain a certain cost of capital, and that if they continue to borrow, some of those costs can go up because of these loan covenants, and those often have to be disclosed in the financial statements. Now, we look at a couple things, growth rate, and we look at profitability when we were trying to determine the use of our capital, our retained earnings, essentially, for financing. So we need to look at growth rate, okay? And basically, we're going to have to give a formula for this. So go ahead and flashcard that. And of course, flashcard means you probably already have the formula, but I want you to memorize it. And our growth rate is going to be our return on our assets times our retention rate, okay? And then we're going to divide that by 1 minus that formula, the return on assets times the retention rate, to see what the growth rate is. Now, let's take a look at what retention means, and that will need to be included on your flashcard somewhere. Retention is equal to the addition to retained earnings divided by our net income. This is also thought of the portion net income not paid out in dividends. So there's a couple of different ways they could give that to you or make you calculate that. They could just tell you, of course, what the retention rate is, or they may sit there and say, well, they've paid a dividend of this, and here's their net income, and you're gonna have to use the complement of that to figure out what the retention rate is, etc. So, but let's go ahead and take a look at this. And company calculates return on assets at 7.5% in the current year and follows a policy out of paying a 40% of all earnings as dividends. Well, that then means that they're keeping 60% of their earnings in the retained earnings, and that therefore becomes our retention rate. And so you can see then they just go ahead and use the formula for the growth rate, which is 4.7%. Now, we also want to consider the profitability of the company. And when we calculate the profitability, we have 3 ratios that I'm sure you're familiar with that we're going to have to take a look at here, which is return on sales, return on investment. Hopefully Junifero doesn't mind us using his name as an acronym for that, because I saw ROI up there. So, oh, okay. Oh, ROI is our return on investment. And then we have our return on assets, and then we have a return on equity. Okay, so here we go again with some flashcards. I mean, you're gonna have to know these formula. Return on sales is going to have our net sales. That's what? Sales minus returns and discounts. Okay, sales minus returns plus discounts is our net sales. And then in the numerator, we'll have our income, but we consider our income before interests, income, expenses, and taxes. So really, we're talking about what? We're talking here about sort of our operating income, okay? And that we're taking out interest and expenses and taxes off of our income, okay? Or if they give us net income, then they'd have to give us what the interest items were in the taxes, and we'd have to add those back, however they would articulate that in the question. The return on investment is our net income divided by our average invested capital. Return on assets is going to be our net income divided by our average total assets. And then our return on equity is our net income again, divided by the average total equity. And that's going to be how we will use those to calculate our profitability. Okay. Now you come over and we start talking about our leverage. Okay, and there's two leverages that we're going to talk about here. We're going to talk about our operating leverage and how that will create risk, and then we'll talk about financial leverage, okay, and how that can, each of them can create or mitigate risk, create or enhance opportunities for the company. So operating leverage really gets defined around our fixed cost versus our variable costs. So operating leverage is the degree to which the company uses fixed operating costs rather than variable operating costs. Capital intense industries often have a high operating leverage. Labor intense industries generally have a low operating leverage. So when you take a look at the next discussion of the implications here, actually, let's do this. There's a little picture I wanted to draw you here. So if fixed cost are up, then maybe I'll do it this way. Fixed cost up. Okay. Operating leverage. It says operating leverage is up. Okay. If fixed costs are going to be coming down or lower, I don't know if they're coming down, but they're lower, then our operating leverage is lower. And the idea being that once we cover our fixed costs, we're going to have a steep increase in our profitability, but we have the risk that we have to generate enough sales to get over that fixed cost hurdle, right? A contribution margin large enough to get over that hurdle. But once we get over it, then a large increase in profitability. If our cost structure is more that we have more variable costs, lower contribution margin, and so now what? Now we're going to not have as much of a leverage as we get past those fixed costs. So let's just go ahead and take a look at how the book articulates that. Okay, and a company with a high operating leverage must produce sufficient sales revenue to cover its high fixed operating costs. High operating leverage is beneficial when sales revenue is high. That results in a higher contribution margin, which indicates higher operating leverage. Obviously, my fixed costs are higher, my variable costs are lower, my contribution margin is up. I have a higher operating leverage because once I cover those fixed costs, everything then contributes to the contribution margin. First contributes to fixed costs and then profit, right? A company with a high operating leverage, however, will have greater risk, but greater possible returns. There is risk because the variability of profit is greater with higher operating leverage. In other words, if I'm not generating the sales to cover that fixed cost, I'm going to be in that loss section there for a long time, and I could, see decline obviously in the value of the company. Now, when sales decline, a company with high operating leverage may struggle, as I've just said, to cover its fixed cost. However, beyond the break-even point, a company with higher fixed costs will retain a higher percentage of additional revenues as operating income, okay, which they're defining here as earnings before interest and taxes. Okay, that's commonly used in some of these calculations to say that operating income is earnings before interest and taxes. You'd also, it's not quite operating revenue because earnings before interest and taxes is not considering gains and losses on the sales of equipment and whatnot. So it's not so much operating income as it is earnings before interest and taxes. So be careful with that. They say operating income. It often is operating income, but that's not a clean definition of operating income that they're giving us. So you would have to look for, I think most questions are going to give this to you. They're not going to call out operating income. They're going to call out earnings before interest and taxes. I doubt that a question is going to make you choose between operating income and earning before interest and taxes. So you're going to have to read the question carefully to make sure you're picking up that right number there. Okay. Okay, good. So flashcard that part, but let's just go ahead and let's just take a look. And these examples are not particularly helpful, but let's just read one anyway, just to kind of make sure we're feeling like we're getting an example here. So when Pat Jones compared the company's operating leverage with the competitor's operating leverage, Jones found that the company experienced a 21% increase in earning before interest and taxes as a result of a 5% increase in sale, while the competitor experienced only a 10% increase as a result of 5% increase in sales. So Jones Company has what? Jones Company has a higher operating leverage than the competitor, which implies that fixed costs constitute a higher portion of the company's total when compared to the competitor. Okay, I don't know. Seems like somebody felt like writing something and just went ahead and did it. I don't know that these examples are that helpful. So let's just move on to the notion of financial leverage. Okay, now when we look to financial leverage, now we're saying, well, look, do we have a large portion of debt financing? Because if we do, then all we really have to do is cover that what? Cover that fixed debt financing. And then once we do, then we have additional amounts of income that will go towards our profitability. So financial leverage is the degree to which a company uses debt rather than equity to finance the company. So let's just go ahead and flashcard that. And then you take a look, and a company that issues debt must produce sufficient operating income. Again, they're being a little loose with the definition of operating income. It's earnings before interest and taxes to cover its fixed interest costs. However, once these fixed interest costs are covered, EBIT will go straight to net income and earnings per share. Okay, now you take a look. A high degree of financial leverage implies that a relatively small change in earnings before interest and taxes will have a greater effect on the profitability and shareholder value. Again, another benefit of financial leverage is that interest is tax deductible. Of course, you know well that dividends are not. Companies are highly leveraged, must be at risk of bankruptcy if they are unable to make the payments on their debt. They also may be unable to find new lenders in the future. And that's why often the lenders will go ahead and they'll say, hey, we're going to put a debt covenant in there to keep you from issuing debt on top of debt. Because we have this risk here when we're trying to exercise financial leverage, and so they use loan covenants to protect themselves against that. Okay, so you come over, and guys, I'm not going to go through those examples. I think you get the point. The more the debt, the more highly leveraged the firm. Okay, but also the more risky. Okay. So let's go ahead and take a look at how we'll calculate the value then of the leveraged firm. And a leveraged firm is a company that has debt in its capital structure, whereas an unlevered firm has only equity and no debt in its capital structure. The formula for calculating the value of the leveraged firm, assuming the debt is permanent, is shown below here. And another formula for us. And remember that our debt is deductible. So we're going to take the tax rate and we're going to multiply that times the debt rate, the interest rate on the debt, times the amount of debt, and then we divide that by the interest rate on the debt, and that tells us the value of the leverage firm, okay, right here. Okay, and of course, we'd have to add that to the value of an unlevered firm, and that would allow us to calculate the value of a levered firm, leveraged firm, levered firm, I guess is better English. Okay. Okay, good. Come down, impact of capital structure on our financial ratios. Now, oh, sorry guys, we can look at this example. This example is helpful. I don't want to skip that. Okay, so let's just take a look at the value of the levered firm, and they tell you the value of the company with no debt capital structure is 130 million. We're gonna have to write that down. We know we need that. The company has recently issued 25 million in debt with an interest rate of 5.75. But again, we have to go ahead and take that interest and multiply that times the tax rate here. Now here it's the tax rate. It's not 1 minus the tax rate. It's the tax rate that we use to calculate the numerator here. And then the denominator is the interest rate. And that gives us now the value of the levered, they call the levered firm. Okay, good. I think we can take a quick break here because we're going to start to get into, let's go ahead and then we'll take the break after our next multiple choice question, I think, because really all we're looking at is how capital structure will impact some key financial ratios. And so an entity's solvency or ability to meet its long-term obligations is affected by the amount of debt in the capital structure. Solvency can be measured using ratios such as debt to equity, debt to asset ratio, and the times interest earned ratio measures the entity's ability to meet its interest obligations on long-term debt. So, and these are some of the easiest ratios on earth, but please flashcard them. Debt to total debt ratio is our total liabilities divided by our total assets. Debt to equity ratio is, tells you what they want you to put in there, but flashcard that. Total liabilities divided by our total equity, okay? And then we have something called the equity multiplier. Equity multiplier is the ratio of the total assets to the total equity. And then times interest earned is going to be earnings before interest expense and taxes divided by our interest expense, tells us the times the interest earned, and you will flashcard and memorize that. Okay. Okay, good. So before we go to the break, then let's just go ahead and look at this class question. And my hint here is I'm going to give you a minute and a half to work this question. You'll see why after I know you see a lot of numbers there, but you'll see why I'm giving you only a minute and a half once you start to see what they want you to do with this question. Okay, guys, let's go ahead and wrap this one up. This one's pretty straightforward, so I'm going to end the poll here. And good, nice percentage here, 86%. And I think you can see in this question from the numbers, which we did not have to use to answer this company is not very well leveraged because they have this almost 40 million in equity and only 10 million in debt. And so they tell us that issuing stock, and they want to know how we could increase the leverage. Well, not by issuing more stock. Okay, so that's out in both of those. Those two would be, one would be A would be a wash. B would decrease our leverage. D, financing its future investments with higher percentage of equity funds. That's going to make the situation worse, right? However, financing its future investments with higher percentage of bonds, which almost everybody got right, would be the way to do it. Okay, good. That takes us to a good breaking point. So I'm going to go ahead and say that we will come back at 6:30. I am going to pause the recording. So somebody please do me a favor and remind me to start that back up if I don't remember myself. Okay, guys, we're going to go ahead and get started back, and I've resumed the recording now. So let's just go ahead and take a look. And of course, my phone starts ringing as soon as we start back to class, right? But let's go ahead and take a look at working capital, okay? And as I think you all know, I don't want to, insult anyone's intelligence here, but working capital is defined as the difference between our current assets and our current liabilities. Now, we were talking before we went to the break, the impact of capital structure on various ratios. And, we're going to continue with discussion of ratio. And I know, guys, that it gets a little daunting when I sit here and I say, well, memorize this formula, memorize that formula. The good news is with some of these formula is if you memorize them for BEC, they're also useful for audit. They're also useful for FAR, not so much reg. It's beneficial to memorize them for this exam, and then you kind of have them in your head. Of course, you'll have to probably remind yourself of when you take those other exams, but it's useful for 3 of the 4 parts of the exam. So our current ratio is very simple: current assets divided by current liabilities. Now, we would want this number to be more than 1. 2, 3, 4 might be considered a good current ratio, where you'd have a problem, of course, if it was less than 1. That means your current liabilities are more than your current assets. This company is going to be having some solvency problems, right? It's basically looking at short-term solvency. But by the same token, I don't think we would want this number to be ridiculously high, because then it would indicate that the company is potentially doing what? Hoarding cash that should be being used and reinvested in the company and whatnot. So I don't know that we'd want a current ratio of 10,000 or something, because then you start to say, well, hey, free up some of that cash and get that out into some investments where we can start to get a return along the lines of what we've been talking about in the previous section. Okay, good. Now you come over and we can get an even more critical measure of a company's solvency by using something called the quick ratio. Again, I think you're probably pretty familiar with this. Notice we do not, the numerator, basic math, John, the denominator is the same. For the numerator, we do not include what? We do not include inventory. We do not include prepaids, right? And the idea being that, hey, you're really not going to be able to use prepaids, obviously, to pay off current liabilities. And inventory, can be obsolete, could be difficult to move and whatnot. So to be even more critical of our measure of our solvency, we could use the quick ratio. Make sure too that we remember that our receivables net, what we mean by that is our account receivable minus the allowance for uncollectible, right? So they might give us the not give us the net, we might have to calculate that. Okay, good. And again, the quick ratio is a more rigorous measure of the solvency, the liquidity of the company. Okay, good. Let's take a look at our cash conversion cycle. And when we look at our cash conversion cycle, and you can go ahead and flashcard this, we're saying, well, look, how long do our items stay in inventory? What are our days in inventory, of our inventory items? How long is it going to take us to convert our inventory to cash, is essentially what we're saying. So how many days do items stay in our inventory? But then if we have credit sales, how long does it take us to collect on those credit sales? But we don't necessarily have to acquire our inventory with cash, so we would subtract off of that the days that our payables are outstanding, and that would give us a measure of our cash conversion cycle. Okay, good. So you can go ahead and take a look at how to calculate the various elements of the cash conversion cycle. And we could see that days in inventory is going to be made up of, and we're going to probably have to do two calculations, guys, for these, is the way I tend to look at these, which is the cost of goods sold divided by the average inventory. That tells us, and we don't necessarily sell out of our inventory, but I'm going to say it tells us how many times in a year we would sell out of our inventory. Not that we'll ever do that, but how many times will we sell out of our inventory in a year? That is considered our inventory turnover. And average inventory, guys, don't forget, is going to be what? Beginning inventory plus ending inventory. And then we divide that by 2. And sometimes students will say, well, why are we dividing it by 2? And the reason is because there are what? 2 numbers in the numerator. To get the average of those 2 numbers, you divide by 2. We consider that the average inventory. Now look, it's a rough measure of our average inventory. If you were building a bridge and you measured the wind velocity at the beginning of the year and the end of the year, it said there, that's the average wind for the year, the bridge is probably going to fall down. Okay, that's not a very good measure for something like that. For an analysis like this, we're just trying to get a rough estimate of what the inventory turnover is, and so we do it that way. Now, days in inventory says that you will take the ending inventory and you will divide that by the cost of goods sold divided by the 365 days in a year. This is just me, guys. I like to say, well, I like to take the 365, days in a year, and it just is a little more meaningful to me if I then divide that by the turnover. And I don't mean Apple, I mean the inventory turnover. I just divide that by the turnover. That also gives me the days in inventory, how long something sits in inventory. Now, of course, if the problem doesn't give you the information to calculate the turnover, then I guess you'd have to do it this way, the way they showed you here. So flashcard that, but also realize that, you could also get to the days in inventory this way as well. Okay, good. Come over and let's look at the next element of our cash conversion cycle here, which is going to be our days in account receivable. And our days in account receivable is going to take our net sales. And guys, I want you to flashcard all these. And I'm not going to repeat net sales or write it again. I'll repeat it. Gross sales minus returns minus discounts, as you well know, is our net sales. And then we're going to go ahead and divide that by the average receivable, and that's the beginning plus the ending balance of the receivable divided by 2. And that tells you how many times you basically collect out all of your receivable. Although the receivable balance will never go to 0 during the course of the year, it tells us how many times it would have gone to 0 if we collected all of our receivables before making any more sales. And then to get the days in account receivable, you're going to go ahead and divide the ending account receivable, again, net of the allowance, divided by the sales, divided by the 365 days in a year. Or just remember that you could also take the turnover. Again, now we're talking about account receivable turnover, and divide that into the 365 days in the year, and that would give you the days in receivable as well. Now, for the inventory turnover, it really kind of depends on the industry. You know, I would think a real estate entity would probably have a fairly large days in inventory, because it takes time to go through the process of marketing something, and then there's always some paperwork and whatnot and registering that has to be done, even if you sold it the first day you put it on the market. So that will probably be a little longer. A sushi restaurant has an inventory turnover of a day, okay, maybe 2. Okay, so it really depends on the industry. If we're talking about accounts receivable turnover, although there's not a standard, I mean, God doesn't come down and tell us what the number should be, but I would say 30 days, 60 days at the most is what I'd be looking for days in account receivable. Okay. Now you come to the third element of our cash conversion cycle, and that's the days that our payables are outstanding. And again, we'll have our account payable turnover, which is our cost of goods sold divided by our average account payable, and flashcard that, which again, there's probably a flashcard for that, but if there's not, please make that flashcard. And then days of payable outstanding is the ending accounts payable balance divided by the cost of goods sold divided by 365, flashcard that. Or again, the turnover divided into the 365-day year. You could get there as well for that one. Okay. Okay, good. So let's go ahead and this is a good example of what a simulation might look like, guys. And I'm not going to go through this one with you, but you can go ahead and review this. But I could see, because it's just, it's just taking the numbers that we have in this question and plugging them into those formula. I don't see that we're going to get a whole lot out of that. But just know that I could see potentially a task-based simulation where they're asking you to sit here, and it's not just related to the days and the cash conversion cycle elements. It could be any of the ratios. I could see that they could give you task-based simulation where they're making you calculate a bunch of ratio and then asking to analyze what these different ratios could mean. So take a look and note that this analysis that we're giving here could also be and that I do want you to write in here, a good written communication question, right? When they start getting into the analysis of, well, what does all this mean? We want you to calculate it, but now we want you to write a memo explaining what these different things mean. So let's go ahead, and I kind of mentioned some of this here a minute ago as we went through, but let's just go ahead and talk through a couple of these. I don't want this red, I want this to be yellow. Okay, and days in inventory, and a company is doing well when it quickly converts its inventory into sales. More days in inventory could mean that the inventory is becoming obsolete or is therefore going to be a sunk cost to the entity. If the days in inventory is too short, the company may not have enough inventory on hand to support potential sales. And again, a good, you can, yeah, go ahead and flashcard that. And the reason I want you to flashcard that stuff, guys, and you're saying, okay, John, this is kind of common sense, but I want you to flashcard it, good accountants, common sense. But I want you to flashcard these things, guys, and take this suggestion seriously, because I want you to be looking at your flashcards the days before your exam. When you look back at our how to study write-up that I gave you, and it's posted on e-learning, I talk about looking at those flashcards the days prior to your exam, and then I tell you to bring the flashcards with you to the exam site. Now, don't try to sneak them in. That's not what I'm saying. But do one more round with the flashcards in your car before you go in. And then you get that written communication, and that stuff's just kind of right there in your head, and you can quickly do a nice job using good grammar for your written communication on something like this. Okay. Now we look at the days in accounts receivable, and fewer days in account receivable is ideal. The company is ideal, although the company may lose sales if its credit collection policies are too strict. That's pretty standard though, right? 30 days is probably about what most companies are going to put on the terms of a credit sale. Too many days in account receivable indicate that a company is struggling to collect from its customers. So we start seeing that number getting into the 60-day category. You've got to be looking at the collection problem, and you're probably going to see that supported by a large percentage of our accounts receivable being eroded by the allowance for doubtful accounts, right? So you can flashcard that. Okay. Days of payable outstanding. Okay, company converts cash, conserves cash by delaying payments to vendors. Too short of a period presents risk of not fully utilizing cash. Too long of a period means that hey, you may be deteriorating relationship with the vendors, or I'm going to write in here, and I don't know why they didn't say that. It could, too long a period could indicate what? Could indicate cash management problem. Let's write that in. Could indicate cash management problem, right? I don't know why they didn't mention that. To me, that would be my major concern there. If I'm saying, well, look, credit terms are generally 30 days. This company has an accounts paid days in payables outstanding of 90 days. What the hell's going on here? I bet you there's a bunch of, delinquency letters, from their vendors saying, hey, you're not paying on time, right? Okay. Okay, good. Coming over, working capital turnover. Let's just flashcard that. Again, guys, I think you have these flashcards in your set, but if you're missing any, then you're going to have to make them by hand. Again, average for all of these things is to take the beginning and the end and divide by 2. So anytime we call out the average, that's what we're talking about. Okay. Okay, good. Analysis. A higher working capital turnover ratio implies that the company is doing a relatively good job converting its working capital into sales. Too low of a ratio implies too much money is invested in current assets, such as receivables and inventory, relative to the amount of sales the company is generating from that capital. Yeah, so that's another problem with too high of a working capital number, right? Too high of a ratio implies that there are not enough capital in place to continue to support operations and sales. Okay, so go ahead and flashcard again the implications, interpretation, analysis, whatever you want to call it, of those different ratios in case you get some sort of task-based simulation. Written communication requirement there. That's what I'm thinking. All right. All right, good. Let's go ahead and let's take a look at our next class question. Read this question carefully, guys. I'm seeing a bad trend here. Read that question a little more carefully. Okay, let's go ahead and take a look at this one. And yeah, I'm not too happy with this turnout. I think maybe we might have read a little too quickly here, and probably when I told you to go back and look, you realized maybe the mistake you made, because the correct answer here is B, okay? Which, you know, less than half the class got correct. So let's just go ahead and take a look at this one. I'm going to just take the pull down here. But which of the following would increase the working capital of a firm? Well, a lot of folks chose A, and I think maybe you didn't read it carefully. Working capital is current assets minus current liabilities. Well, if I have cash collection of a receivable, I'm just trading one current asset for another. That will have no impact on working capital at all, right? Guys? Yeah.
Yes.
Okay. Okay, good. So you might have read that a little bit quickly, you know, let that be a lesson to you, you crazy kids. Be careful. Read those questions, give yourself, you know, at least a minute to look at those, right? Okay, refinancing account payable with a 2-year note is going to do what? It's going to basically do what? It's going to reduce the denominator, the current liabilities, because a 2-year note is a long-term liability. So it'll reduce the denominator because we'll take a number out of accounts, out of the current liabilities, and put it down in the non-current liabilities. If you make the current liabilities smaller, then the working capital goes up, right? And I'm talking ratio here, but if you're talking current assets minus current liabilities, the difference, the working capital number will increase, right? Guys?
Yes.
Okay. Cash payment of account payable is simply going to do what? That's going to be a 1-for-1. That's going to what? Decrease the numerator or decrease both. Okay. I'm not talking about the ratio here. They say the working capital. I'm defaulting into the ratio. It's going to decrease the current assets. It's going to decrease the current liability by the same amount. That's going to be a wash. Payment of a 30-year mortgage is going to reduce my current asset and have no effect on my current liability. Okay, question on that one? Okay, good. So you probably read that one real quick. You know, an easy mistake to make on the exam is to read the first choice and think that you, oh yeah, that's the right answer to A, and I'm just going to go on to the next question because you're under a time crunch, right? You will always read every choice. I don't care if you are willing to give your firstborn child that the A is correct. Read through the remaining, because I have found that when I read the second one, I'm like, well, wait a minute, that's right also. What the heck's going on here? And that's when I look back at the first one and say, oh, I misread. Yeah, okay, no, A is not correct. So always read through the choices, no matter how sure you think A is the correct answer. Okay, good. Let's go ahead and look at this one. Read carefully, guys. Read carefully through all the choices. Okay, good. Let's go ahead and take a look at this one. And okay, we're still, in my opinion, a little low on this. The correct answer is D. I would have hoped we would have got a little higher batting average on that. But let's just look at this one. And first thing, when I look at a question like this, guys, I think to myself, because I've looked a lot at CPA exam questions. And so I instinctually start looking and saying, okay, which of the following transactions would increase the current ratio and decrease net profit? And what the examiners love to do is give you choices that will not affect both the balance sheet and the income statement. I mean, that's what that question is saying. Which of the following transactions would have an effect on both the balance sheet, which is going to affect my current ratio, current assets divided by current liabilities, and my income statement, which is where I'm going to report my net income, my net profit. So I can immediately get rid of choices that only affect one of the statements or the other. And so I look and at a federal income tax payment due from a previous year is paid. Well, that's going to do what? That's not going to affect the income statement at all. That's a purely balance sheet transaction as I debit my taxes payable and credit my cash, right? Then I look and they say a long-term bond is retired before maturity at a discount. I'm thinking, okay, I'm not sure what that means. A dividend is paid. Well, if a dividend is paid, that does not affect my profitability at all. That is a purely balance sheet transaction. So I can get rid of A and C just by that thought process. Now I got to figure out, okay, the ones that are left, B and we know D is the right answer, are going to sit here and have a balance sheet and income statement effect. So what happens? If I retire a bond before maturity at a discount, okay, that's probably going to do what? That's going to result in a gain, and they're asking me what will decrease net profit. Further, I'm going to what? I'm going to go ahead and get rid of a long-term liability by using cash. So that's not going to increase my current ratio. Okay, but it said it has to do and so you could figure that out just by looking at the income statement effect. Vacant land sold less than book value is going to do what? Well, that's going to give me the gain on the income statement. And even if I couldn't figure out the effect on the current ratio, that now is going to give me the gain. It's the only one that gives me a gain on the income statement. And what's going to happen? If I sell vacant land, my cash is going to go up, my current assets are going to go up, and there's not going to be any effect on the current liabilities. So that's why D was the correct answer.
It should be a loss, correct, Professor?
Vacant land is sold for I'm sorry, yeah, did I say gain? My bad. Yeah, Vacant land is sold for less than book value. I don't know who said that, but that's correct. That is a loss and has a decrease on net profit. So not again, it's a loss, sorry. And that's why it's the correct answer. Thank you. Sometimes I talk too fast. Sometimes I talk too fast. Okay. Okay, thank you. Thank you. Thank you for paying attention. Such good attention. Okay. Okay, good. Let's look at, and there's really no, difference from what we've been talking about here to now, the actual management of working capital aspects, because we've been talking about really cash management to a large extent, but they like to try to chop these things up into smaller bites. And so now they're saying, oh, inventory management. So let's just take a look first at inventory valuation, okay? And we need to value our inventory at the lower of cost or market, or net realizable value, and it really depends on the inventory method. Lower of cost or market is used under LIFO. Lower of cost or net realizable value is used for all other inventory methods, such as e.g., I guess is a better way to put that, e.g. FIFO, weighted average. I'll just make that WA, weighted average. Okay, all other methods use lower of cost or net realizable value. So when we take a look, we can see that when a company, not when a company, but when the value of inventory falls below original cost, inventory must be restated to the lower of market value or net realizable value. Again, market value for LIFO, net realizable value for all other inventory methods. Okay, inventory, and that's what they say here, inventory costed using LIFO or the retail inventory methods measured at the lower cost or market. Inventory using all other inventory methods is the lower cost or net realizable value, okay, which I kind of wrote up there already. If you need to, you can flashcard that, lower of cost or market for LIFO, lower cost or net realizable value for all other inventory methods. For example, FIFO, if you want to make a flashcard out of that, you can, okay? Now, when I took the CPO, important point here. This that we're talking about in here is really a FAR subject. And by FAR, I mean financial accounting and reporting subject. But make sure you're aware that the BEC exam could ask you to provide a written communication about any of the 4 parts. So we're not limited to writing about things that are relevant to just things that are called out as topics in BEC. So the reason we're kind of putting this here is there was a discussion that there was a question that kind of related to the lower of cost or market, the lower of cost or net realizable value as a written communication question. And also, as we'll start to look at it in a minute, the financial statement implications of using different inventory methods. And so that's really why we're covering this here. So even though we're going to show you a calculation, my prediction is that they could be asking you about this kind of stuff here as it relates to a written communication topic. Okay, so take a look, and they tell you that market value represents the median or middle value of the item's replacement cost or the market ceiling or the market floor. Now, again, when we say market value, that means we're talking what? We're talking if we were using the LIFO method. So what you do when you look at this is you need to flashcard these definitions. Now, the problem we'll give you replacement cost if you were having to do this in a numeric problem. They would give you replacement cost. They said, here's a replacement cost. And they say, that is your market. And you have to evaluate that against a market ceiling and a market floor. If the replacement cost is more than the ceiling, then use the ceiling. If the replacement cost is less than the floor, then use the floor. If the replacement cost is not over the ceiling and not below the floor, use the replacement cost as your market, compare it to the cost, and then report that item at the lower of what you just calculated as the market or the cost. Okay, so you're really evaluating replacement cost. And when I took the exam, the trouble I had with some of these questions before I took the exam, but I cleaned that up before I took the exam, was I had trouble remembering the definition of ceiling and floor. But once I flashcarded those definitions and memorized them, those questions became very, very straightforward for me. So the market ceiling is the net selling price less cost to complete and dispose. What does that mean, cost to complete and dispose? For example, if they tell you there's delivery cost, that would be a cost to complete and dispose. I mean, I used to think cost to dispose, you mean like throw it away? What are you talking about? If you're gonna throw it away, it's worthless. No, they mean to sell it. If you have to pay some delivery cost or something, commissions, then you would subtract that off of the net selling price to get the market ceiling or net realizable value, okay? That is AKA net realizable value. NRV is net realizable value. Market floor is what? The market ceiling that we just calculated less a normal profit margin, okay? Now, net realizable value, you can see we're telling you there, which I just had you write in, net realizable value is equal to the net selling price less cost to complete and dispose. In other words, the market ceiling, and we would use net realizable value if we are talking about what all other inventory methods other than LIFO, okay? So come over and let's just look at this example, okay? And this is just more, I'm not thinking you're gonna get a lot of questions or even one question that might ask you to do a numeric example, but it helps you to illustrate the what we just talked about, and so it's useful for us to look at. So they tell us that the inventory cost is 55, okay? Now, when I look at that cost, I'm like, okay, I'm gonna carry it at that cost unless the market is lower, but I have to figure out what the market is. Now, they tell me that the current replacement cost is 48. So I'm gonna write that 48, and then I'm going to calculate the ceiling and the floor and see if it goes over the ceiling, I'll use the ceiling. If it goes below the floor, I'll use the floor. If not, I'll be able to use the replacement cost. So they tell me that the current replacement cost is 48, while the net selling price less cost to complete and dispose is 51. Well, that's the ceiling. I know I'm not over the ceiling, so I can already forget that. I'm not going to use 51. And then they tell me that the normal profit margin is 5. So now I'm going to take that 51 that I just calculated as the ceiling, subtract the normal profit of 5, that gives me a floor of 46. So since my since my item is not over the ceiling, the replacement cost is not over the ceiling, it's not over the floor, that becomes my market, and then I compare my market to my cost. And so what happens, since the market has fallen below the cost, I would report that inventory at its lower market. For all other inventory methods, if they're using FIFO, for example, again, you're always evaluating cost, lower cost or market, but now I don't have to calculate a floor. I just simply need to look at what's lower, my cost or my net realizable value. Net realizable value, we said by definition, is the 51, which we calculated as the ceiling earlier. So I'm going to carry it now at the net realizable value. Question? Okay, good. Not too tough. The key thing there, guys, is you absolutely, I think you can see why it's important that you have to know the definition of market ceiling, market floor. Okay. Now we come down and we start talking about cost flow assumptions here. Okay. And when you look at these cost flow assumptions, the way they're being discussed here, we really want to see if we can tease out the financial statement implications of these different methods. And when you think about financial statement implications, we're really thinking about the effect on the balance sheet and the effect on the income statement. And I'm going to tell you, assume, in the way I'm describing it, rising prices. Now you're going to have to read the question and see if they're saying the prices of the inventory are increasing, but typically, as is very much currently the case in our economy, prices are rising. And that's generally the expectation or the default position of the exam question. If prices are falling, then it's going to be the opposite of what I'm going to write in here. And I'm going to give you some very technical ways to think about this. Okay. The balance sheet is going to be better stated. The income statement is going to be a little bit more messed up. That's a sad face. I kind of wrote it in the middle of that. Just so you realize it's a face. Okay, that's a sad face. That's my highly technical way of helping you remember what's going on here. And let's just take a look. And under FIFO, the first cost inventory, the first cost transfer to the cost of goods sold. So what happens? You have rising prices, but we're taking things that we bought some time back and putting those into cost of goods sold. So net income is going to be what? Net income is going to be too high because we're saying that our cost of goods sold is this lower amount because prices are going up. The first things we bought maybe a long time ago, we're putting in cost of goods sold. So we're matching current sales prices against old costs. And that's going to drive up the net income. Net income is going to be too high. Okay. The balance sheet is going to be okay because we're saying, hey, those things that we most recently purchased for inventory, yeah, they're about showing what their current cost is, right? So you can see that here. Ending inventory on the balance sheet includes the most recently incurred cost and therefore approximates replacement cost. Yeah, that's a good thing. That's the happiness. Okay. The sad thing is that what? Net income is probably going to be overstated. Again, I want you to remember about this because there could be a written communication in which they ask you the financial statement implications. And when they ask that, they ask for comparison of LIFO and FIFO. So let's take a look at LIFO then, okay? And let's again do our highly technical drawing here. Now the balance sheet is what? Is sad. And the income statement is happy. And let's just remind ourselves under LIFO, the last cost inventory, the first cost transfer to cost of goods sold. So the stuff that we most recently bought is what's hitting the cost of goods sold on the income statement first, and we're matching that better against current sale prices. So net income is probably okay. Net income is looking right. Okay, but what happens? We're sitting here and we're keeping old things that we bought a long time ago on our balance sheet. So the ending inventory balance typically does not approximate replacing cost because it includes the old inventory items. Okay, so that's why the what? That's why the balance sheet is sad. So the way Becker wrote this question or this description, they wrote it just talking about the balance sheet impact. But if they're giving you a written communication, I think you can get some more points by also talking about the income statement impact. Okay. Question? Okay, good. Now come over and let's take a look at inventory management strategies. Okay. And when we look at inventory management strategies, some of the things we need to think about here are, and you can go ahead and flashcard these: storage cost, insurance cost, opportunity cost. In other words, what happens if someone comes in to buy an inventory item, we don't have it? They'll say, okay, you know what, forget it. I'm just going to go down the street and I'm going to get another from another store. Although these days, seems to me like every time you go in to buy something, they don't have it. But anyway, stop, John. That's maybe my own personal problem. And then lost inventory, you carry too much inventory, then you can have obsolescence, spoilage, other good words, theft, right? Shrinkage. Okay, so all of these are things that you need to consider when you're trying to figure out the right level of inventory to hold. I don't have enough, people going to go somewhere else to buy their stuff. If I have too much, it's going to get damaged, it's going to be shoplifted, stolen by my employees, whatever. In other words, shrinkage. Okay. Okay, good. So what we can do to sort of minimize some of those costs is come up with a economic reorder point that will try to mitigate some of those costs. So the reorder point is the inventory at which a company should order or manufacture additional inventory to meet the demand to avert incurring stock out costs. So that's really just mitigating that stock out cost portion of the considerations that we saw on the previous page. Again, I don't know about you guys, but I find that these days a lot of companies don't seem to worry about the stock out anymore, and you get the obligatory, 2 to 3 weeks for delivery or whatever. Okay, but flashcard that the reorder point includes a consideration of safety stock. The question will give you the safety stock. That's easy enough. And then you're going to figure out how much lead time you need times the sales during the lead time. And once your inventory gets to that level, that's when you will have to reorder. So you can take a look, and we have this worldwide widget, sells 8,000 widgets per year and manufactures widgets in groups of 1,500 and requires 5 weeks of lead time for widget production. Worldwide also maintains absolute minimum safety stock of 1,200. Now, when you see that safety stock number, you write it down. And then if we have 160 widgets we produce per week, and it takes us 5 weeks is our lead time that we need to produce those, then once we get down to 2,000 widgets, that's when we'll have to reorder, because we're giving ourselves enough time to build that inventory back up. And they assumed a 50-week year sometimes. So why 50 weeks? Well, I guess they must have a couple of weeks of vacation or something. I don't know. Okay. Okay, good. Let's go ahead and I guess you need to calculate that 160. Okay. Okay, good. Economic order quantity, guys, and this one you're definitely going to have to flashcard economic order quantity, and then they give you the different factors that could affect the cost of our inventory: order size, annual sales, cost per purchase order. That's when we're buying the inventory, and then our carrying cost. And it's kind of funky because they're telling you you'd have to take the square root of that, and the calculator that you would have on the exam would give you that square root. Essentially, what they're doing is they're using calculus to come up with a way to minimize a particular set of factors in this cost. And I'm not going to read through the question here. I think you can kind of see how you would apply those different numbers to that equation. You know, I don't know why I distinctly remember using this equation on my exam. I had to sit there and somehow I seem to remember having to put the numbers in there. What I don't understand is we didn't have a calculator on the exam, so I know there's no way I took the square root by hand. So I'm not sure why I remember doing that on my exam if we didn't have calculators. So maybe I was dreaming that I had to do that. So, but just make sure you have that formula flashcarded. Okay. Okay, good. Now you come over and take a look at, and there's a few more of these that I don't want to spend a lot of time with, guys. They go on with a lot of observations here and different things that you can read through if you want to. I think a better strategy for these things where they start giving us a lot of definitions is to just look at the questions. And then when you learn a definition from one of the questions, as you're going through your multiple choice question, if you don't have a flashcard that covers that, make sure you create a flashcard that would cover that particular question, okay? But I just want to take a look. Again, I'm not going to sit here and read out, definition after definition, but let's just go ahead and take a look at discounts. Okay, and of course, you know that an entity could have a discount offered to them, and if they don't take the discount, there could be a cost associated with that. So what we want to be able to do is calculate the risk of not taking a discount, and we can go ahead and calculate that through this formula, okay, which is going to take, and we assume a 360-day year, and we take our pay period minus our discount period, and then we multiply that by the discount over 100 minus the discount percentage. Now, I don't think I need to tell you, but just in case you forgot how to read that, that says what? 1% discount if we pay in 10 days. Otherwise, we have to pay the entire amount in 30 days, right? So just using the formula, again, assuming a 360-day year, we would have 30-day period minus the discount period, and then it's the discount over 100 minus the discount. And when you multiply that out, we get this 18.2%. So that's a pretty hefty cost of not taking discounts. I would think most companies would want to take advantage of discounts. And of course, the higher that percentage goes, the more that cost. Okay. All right, good. Let's go ahead then and let's take a look at a couple of our class questions here. Again, lots of definitions, guys. I don't want to sit here and read through all those definitions. If you see a question that requires you to know one of those definitions, then make the flashcard for it, or look in your flashcards. Maybe you have one that covers that. Okay, good. Let's go ahead then and let's take a look at our next class question. Okay, guys, let's go ahead and take a look at this one. And everybody got it right. It's kind of a pain, you know what calculation that we have to do here, but let's go ahead and look at it. But most of us got it right. Good percentage, 93%. But let's take a look at how we would do this one. And just following the formula that we saw, we know we have to have the 360, and we assume a 360-day year, and then we have 30 minus 30-day pay period minus the terms here, 210 net 30. So we have to take the 10 off of that, and then we deal with the interest component of this, which is a 2%, not interest, but the discount portion of that, 2%, and then that's divided by 1 minus the discount, which is the 2%. And you do the math on that, and that's how you got this 36.7%. Okay. All right, good. Let's go ahead and let's take a look at this next one. Okay, I'm going to go ahead and end the poll here. Looks like most of us had a chance to try this one. Most of us got it right. We got, need to share the results here. We got 81%, so good. We're getting some good turnout here at the for some of these questions, but let's just look at this one. So the cost of carrying the inventory is the correct answer, but let's take a look. An increase of which of the following, okay, so we're talking about an increase in which of the following would cause management to reduce the average inventory. In other words, what? Have smaller levels of inventory and have to order inventory more frequently, right? So the cost of placing an order is not going to cost us to an increase in the cost is not going to cause us to carry smaller inventory. We're going to carry more inventory, so we don't have to order as much. The cost of carrying the inventory, yeah, an increase in the cost is going to mean we want to carry smaller levels of inventory to avoid things like obsolescence, shrinkage of the inventory through theft, that sort of stuff, right? The annual demand for the product, the more demand, the more we're going to want to have the inventory so we don't incur stock out costs. Lead time needed to acquire the inventory, if it takes us longer to get the inventory and that time is increasing, then we'll want to carry more inventory since we need more time to purchase or produce that inventory. So B is the correct answer. Okay. Okay, good. So it's not a matter of just knowing those terms that I asked you to flashcard earlier. It's also knowing, how they would impact the levels of inventory that we would cover. Okay, good. For our last module tonight, we're going to look at module 5. I'm going to stop at module 5, even though we probably finish up a little early, because I don't think we can finish module 6, and I don't like to start a module in the middle, before we can finish it, and then we got to start in the middle when we reconvene next week. So let's just look at module 5, and then we'll finish up. And we're going to be talking about cash and credit management. Okay, now you come over and you have a couple of accounts receivable ratios that we've already talked about, guys. Okay, so I'm not going to sit here and repeat those ratio here, and that we've already talked about the account receivable turnover in days in account receivable. Just know I want you to flashcard those, right? Now, days sales in accounts receivable, we talked about the turnover, but days sales in account receivable, I do actually want you to flashcard here because we haven't talked about it yet. So days sales in account receivable, you can flashcard, is going to be calculated as our ending account receivable divided by the sales net times the number of days in the period. That's going to give us our days sales in account receivable. Okay, so that's a little different than the days in receivable that we talked about before. It's the days sales in account receivable. So flashcard that. We already talked about the turnover. Okay, methods to speed collections. Okay, I'm not going to ask you to what the hell, let's flashcard these. Okay, guys, I wasn't going to ask you because maybe they're common sense, but yeah, let's do them. Okay, customer screening and credit policy, right? Make sure our customers have good credit. Prompt billing, offering payment discounts. Okay, very high level stuff. Expedite deposits. Okay, make sure that once we are receiving, say, checks or whatever, those are quickly getting deposited. One way of doing that is by having electronic fund transfer using a lockbox system. Okay, and that's by having the bank receive payments directly from the customers. Is called a lockbox. Not only does that speed collection, it also can be thought of as a good internal control. For you guys that are taking the auditing class, we'll be talking about that, because our employees are never tempted to steal any of our receipts because it goes directly to the bank. That's what they mean by a lockbox system. Okay, having a concentration bank that basically is characterized by doing all of our banking at a concentration bank, which improves controls, reduces idle balances, and improved effectiveness for investments. Okay. Factoring is also a way of collecting cash more quickly, and we just simply sell our receivables to somebody called a factor. Now, of course, there's always a charge for that, but you can just flashcard that factoring is a way of increasing our speed of our collection on cash as well, which I guess we flashcarded all of these at a high level. But factoring, you may want to put a little more detail, because you don't really think of factoring and know exactly what that means. They give us an example that's really well beyond the scope that we're not going to need to worry about how to calculate any savings by using factoring. Letter of credit, okay, is an arrangement with the bank, third-party guarantee, that is going to let us be able to borrow money at a specific interest rate, etc. Line of credit is where we are going to be able to receive a loan from a bank. Okay, these are very, very basic terms. We need to be careful with debt covenants. Okay, debt covenants is something that creditors will put on us to prohibit us from borrowing, I should say, our way into bankruptcy. Okay, common debt covenants are limitations on issuing additional debt, restrictions on payments of dividends, limitation on the disposal of certain assets. So, debt covenants are really a way that bondholders try to protect themselves, right? So they'll say, hey, debt covenant is you're not going to be issue any more debt after this, or if your debt to equity or debt to asset ratio goes to a certain level, then you're going to have to pay immediately on our debt. We want to make sure we get paid. So there's a way that bondholders protect themselves through debt covenants. Right? Okay, good. Let's go ahead and let's take a look at the next page here. And again, some terms that we want to understand. Okay, and basically looking at the difference between short-term and long-term financing. Okay, some advantages, disadvantages of short-term financing. Rates tend to be lower because there's less risk that interest rates are going to fluctuate against the lender, right? So interest rates tend to be lower. Effect on working capital is defined as current liability is a short-term financing. So it's going to reduce our, decrease our working capital. Let's look at the advantages, disadvantages, and I want you to flashcard this because of short-term financing. And I want you to flashcard this because the examiners like to ask, advantage, disadvantage, where advantages, disadvantage of short-term versus long-term financing, for example, which we'll look at in a minute. But let's just take a look for the advantages of short-term financing, rapid conversion of operating cycle components into cash, in order to meet short-term obligations, carries the potential of increased profitability, lower interest rate, etc. And we can decrease our financing costs through the lower interest rates. Disadvantage, increase interest rate in that, hey, yeah, we got a short-term loan at a nice interest rate, but then, a year down the road, interest rates may go up, and then we're going to have a problem, right? Increased capital availability, lender evaluation of credit worthiness may change, thereby making financing impossible or less favorable by virtue of increased rates or less favorable terms. Okay, I mean, you can flashcard these, but you can almost think of this as, hey, this is why you maybe want to do more a longer term, say mortgage of your home, let's say, than a shorter term, because you don't want all of a sudden have something important like your housing cost all of a sudden jump because there's been an increase in interest rates, or you have to go back out and get more credit in a shorter period of time when there's been, interest rates have moved against you. Okay. Long-term financing, okay, the rates tend to be higher, okay. Effect on working capital, financing is classified as non-current and is not included in the calculation of working capital. So you can go ahead and flashcard that, and then come over. Did I tell you to flashcard this part? Flashcard this part too. And then come over and let's look at the advantage, disadvantage, flashcard, okay. Advantages, decreased interest rates for the borrower. Long-term financing locks in an interest rate over a longer period of time. Increased capital availability, securing long-term debt guarantees financing over a longer period. Disadvantage, higher financing cost. Again, they're going to give you a longer rate. That rate's going to be a little higher because they want to protect themselves against fluctuations. Increased financing cost. Long-term debt generally carries higher interest rate given the long duration of the financing instrument. So you can flashcard advantage, disadvantage, okay? And then let's go ahead and let's look at this class question. key word here, guys. What do you think? Primary is an important word here. Okay, good. Let's take a look at this one. I'm going to go ahead and close the poll, and you can take your best shot now. And okay, yeah, we got split here, although favorable to the right answer between C and D. Okay, so let's go ahead and take a look at this question. Get this poll out of the way. D is the correct answer. What would be the primary reason for a company to agree to debt covenant limiting the percentage of long-term debt for the company to agree? So we're looking at it from the standpoint of the company, right? Okay. So even though some of us chose C to reduce the risk to existing bondholders, that's not the best reason for the company to agree. The best reason for the company to agree is they'll say, look, we want to, protect the new lender here in this bond covenant. And the new lender is going to say, will give you a better interest rate, but I want you to promise that you're not going to issue any more debt until you pay off this debt to protect the new bond issuer, and I'll give you a lower interest rate if you do that. And the company's motivated to agree to that because they want a lower interest rate on that bond, right? The coupon rate is the interest rate on the bond. To cause the price of the company's stock to rise, maybe if there's a sense that they're not going to be issuing a lot of more debt because of these covenants, it might cause the stock value to rise, but the word primary blows that out of the water. Nobody chose that. To lower the company's bond rating, why would they agree to anything that would do that? I mean, that would not, that's obvious nonsense. Okay. Question? Okay, guys, we are going to get out a little bit early because I don't want to start to get into things in module 6 that we can't finish. So make sure that you are in good shape wrapping up chapter 1 if you haven't finished all your homework for that. That includes looking at both multiple choice questions and the task-based simulation. And then you should be in good shape to flashcard up and get through your homework for module 5. You got a lot of flashcards, so I would not sleep on getting into making those flashcards during the week here, so you can knock out some homework questions before we reconvene on Tuesday. Questions? All right, guys, have a good rest of the week. Good work. We will see you next week.
Okay, thank you.
Thank
Thanks.
you. Have a good night.
Thank
Good night.
you.
John, I was wondering if I could bug you about something personal really quick.
Yeah, sure. Hang on one sec. Let me stop the recording.
I also have a question when he's done, but it just pertains to being gone next week.
Oh, you can go first.